All right, hey, for the next few minutes, think of me as your personal financial coach. We are going to settle one of the biggest, most argued about questions in all of finance. Should you pay off your debt first, or should you be investing that money instead? Let's find out who the real winner is.
So, should you go all out, laser-focused, and just attack your debt with everything you have? Or does it make more sense to make those minimum payments and let your money grow in the stock market? It's a question that trips up so many people. Today, we're going to make it crystal clear by watching a race between two friends.
You've basically got two main schools of thought here, right? On one side, you have what's called the gazelle intense approach. Think Dave Ramsey. It's all about building psychological momentum, getting those quick wins, and freeing up your income for good. And on the other side, you've got the mathematically optimal strategy, which says, hey, if the stock market can earn you more than your debt is costing you, well, you should invest. Let's see how these two actually play out in the real world.
To really get to the bottom of this, let's meet our two contenders, Jake and Marcus. They're going to help us see exactly what these two very different financial paths look like.
Now, to make this a totally fair race, Jake and Marcus are starting from the exact same spot. Same age, same income, same amount of debt, the whole 9 yards. And here's the key. After they pay all their bills and their minimum debt payments, they each have an extra $600 every single month. They're at the same starting line, but they're about to run two completely different races. So Jake decides to go with Team Ramsey. He is going gazelle intense. Every single penny of that $600 surplus is aimed like a heat-seeking missile at his debt. He's using the debt snowball method, which means he's going to throw everything at the smallest debt first, that nasty credit card, just to score a quick psychological win and build some momentum. Marcus, on the other hand, is our math guy. He's looking at his loans and thinking, okay, most of this debt is under 7% interest. But the stock market historically returns about 10% a year, so his plan seems pretty logical. Just make the minimum payments and invest that $600 surplus into an S&P 500 index fund every month. On paper, you gotta admit, this looks like the smarter play.
And they're off. For the first 2 years, both Jake and Marcus stick to their plans perfectly. So, let's check in on the scoreboard and see who's jumped out to an early lead.
And wow, after just 24 months, Marcus looks like an absolute genius. He's been investing that $600 like clockwork, and with a little help from the market, his portfolio is already sitting at over $16,000. He's building wealth, and that's got to feel amazing.
Meanwhile, Jake's investment account, it's got a big, fat zero. Nothing. Every spare cent has been going to destroy his debt. So, if you were just looking at their investment accounts, you'd think Marcus was winning this thing in a landslide. But that's not the whole picture.
And this, right here, is the absolute heart of the entire debate. Spreadsheets and calculators, they assume we are perfect logical robots. They don't factor in things like fear or stress or just plain old lack of discipline. Spreadsheets assume a perfect world, but you and I, we live in the real one.
And this just perfectly shows the massive flaw in the math-only approach. Think about it. Every single month that Marcus is hoping for a 10% gain in the market, he is paying a guaranteed 22% interest on that credit card. He's locking in a huge loss trying to chase a potential gain. That's not being financially savvy. That's letting your money just bleed out.
Now, I have to put a big asterisk here because there is one exception where the math is so good you just can't ignore it. If Marcus's job offers a 401k match, that is an instant, guaranteed 50 or 100% return on his money. It is literally free money, and you should always, always, always contribute enough to get that full match before you do anything else, period. Okay, so Marcus definitely has the early lead, but personal finance is a marathon, not a sprint. So let's hit the fast forward button. We're not just jumping ahead a few months. We're going a full decade into the future. Let's see who really came out on top.
So let's look at Jake's journey. In just under 3 years, we're talking 34 months, he is completely debt-free. His entire paycheck is his. Think about that feeling. After quickly building up his emergency fund, he can now invest a massive $1,450 every single month. That's his original $600 plus all the money that used to go to debt payments. And here it is, the final score. After 10 long years, Jake has a net worth of about $170,000. And Marcus, who invested for that entire decade, he's at about $150,000. That's right. Jake started investing almost 3 years late, and he still ended up with more money. How is that even possible?
Okay, let's break down exactly why this happened. I promise you, it's not some kind of financial magic. It really comes down to a few simple but incredibly powerful ideas that you just won't find on a spreadsheet.
So first, let's just look at the straight-up numbers. By wiping out his debt so quickly, Jake saved thousands upon thousands of dollars in interest payments. That's money that went into his pocket, not the bank's. And second, and this is huge, once he was debt-free, his investment shovel got way, way bigger. I mean, $1,450 a month is going to grow a heck of a lot faster than $600 a month, even if it has a head start.
But honestly, the math is only part of the story. The real secret weapon here is something called the behavior gap. See, Marcus's plan required him to be a perfect, emotionless investing robot for an entire decade. He couldn't get scared when the market crashed. He couldn't get greedy when it soared. He just had to stick to the plan. And in real life, almost nobody can do that.
And look, this isn't just a theory. The data is actually pretty shocking. Studies from big firms like JP Morgan have shown that over a 20-year period, while the stock market itself returned about 10% a year, the average investor only made about 3%. Why? Because people panic. We let fear and greed drive our decisions, and we buy high and sell low.
And this is why Jake's plan worked so well. It was psychologically bulletproof. For those first 3 intense years, he didn't have any investments to worry about. You can't panic sell stocks that you don't even own. His plan was simple, his focus was singular: kill the debt. And that protected him from his own worst enemy, himself.
So, we've watched the race, we've seen who won, and we've talked about why. Now for the most important part. What does all this mean for you? How do you decide which path to take?
Here is a super simple decision tree to help you out. Step 1, always get your 401k match. Don't leave free money on the table. Step 2, if you have any debt over 8%, like credit cards, the math and the behavior are on the same team, pay it off now. Step 3, if your debt is super low, like under 5%, the math really does favor investing. And step 4, for that gray area in between, say 5 to 7%, that's when you have to be brutally honest with yourself. Are you disciplined enough to stick with an investing plan for a decade no matter what?
Because at the end of the day, here is the absolute truth. The best financial plan on earth isn't the one that looks the most perfect in a spreadsheet. It's the one that you will actually see through to the finish line month after month, year after year. So the real question you need to ask yourself is, which one of these plans are you actually going to stick with?